Listen very carefully, because what you're about to see in the silver market right now is not panic, it's not randomness, and it's definitely not a natural crash. This drop was designed, engineered, timed. And if you don't understand what's really happening in the next few weeks, you risk doing exactly what they want you to do, selling your silver right before the real move begins. Most people think silver is breaking down. Smart money knows this is a shakeout. And the window we're re-entering right now could decide who benefits from the next run toward triple-digit silver and who gets left behind wondering what just happened. If you've been watching silver lately and feeling confused, frustrated, or even nervous, that's not an accident. That emotional pressure is the tool. Markets don't move people out with logic, they move them out with fear and boredom. And right now, silver is delivering both at the same time. Price drops just enough to scare weak hands, then goes flat long enough to make everyone lose interest. That's how engineered moves work. And this pattern has shown up before, right before some of the most explosive moves in silver history. Before we go any deeper, if you want clear, no-noise breakdowns like this that cut through the headlines and explain what's really going on beneath the surface, make sure you like this video and subscribe to the channel. It helps more than you think, and it tells the algorithm to push this message to people who actually need to hear it. This is the silent ledger. And on this channel, we don't chase hype. We follow the footprints of smart money. Now let's talk about what everyone else is calling a silver crash, because words matter. When the media calls something a crash, what they're really doing is setting the emotional tone. They want you to associate falling prices with failure, danger, and regret. But professional money looks at falling prices very differently. They ask one question first. Is this move organic or is it forced? An organic crash comes with chaos. Volume explodes, correlations break, liquidity dries up. You see disorder everywhere. What we're seeing in silver right now is the opposite. Volume is controlled. Moves are precise. Every dip stops exactly where it needs to stop. This isn't panic, this is pressure. Think of it like pushing a beach ball underwater. The longer it's held down, the more violent the release when pressure finally gives way. That's silver right now. And the people pushing it down are not retail traders. They're institutions that understand one simple truth. Silver is too important to be allowed to rise freely yet. Silver isn't just another commodity. It sits at the intersection of money, energy, technology, and geopolitics. It's used in solar panels, electronics, medical devices, defense systems. At the same time, it has a long monetary history as real money. That combination makes it dangerous to the current system, especially at a time when trust in fiat currencies is quietly eroding. So when silver starts sending early warning signals, the response is almost always the same. Suppress first. Accumulate quietly, then allow price discovery later, once positioning is complete. This is where the fake crash comes in. A fake crash doesn't exist to reflect reality. It exists to shape behavior. It exists to flush out retail holders, shake leveraged traders, and create headlines that justify accumulation at lower prices. And the timing of this one is not random. February into March has historically been a critical window for metals. This is when positioning resets, contracts roll, and narratives shift. It's also when patience is tested the hardest, because nothing dramatic happens on the surface. Price chops, commentators lose interest, viewers click away. And that's exactly when smart money goes to work. If you look at previous silver cycles, the pattern repeats over and over. First, a strong move up that attracts attention. Then, a sharp rejection that creates doubt. Then a grinding, frustrating period that convinces people the story is over. Only after that does the real move begin. Not when everyone is excited, but when most people have emotionally checked out. Right now, silver is in that emotional exhaustion phase. You can see it in the comments. You can hear it in the tone of analysts who were bullish just weeks ago and are now suddenly cautious. That shift doesn't happen because fundamentals change overnight. It happens because price action is doing its psychological job. And while that's happening, something else is going on quietly in the background. Smart money is not selling into this weakness. They're using it. Accumulation doesn't look dramatic. It doesn't come with fireworks. It looks boring. It looks like sideways movement. It looks like controlled dips that never quite break down. Ask yourself this. If silver was truly collapsing, why does every drop keep finding buyers? Why does it refuse to fall apart the way real crashes do? Why does bad news fail to push it significantly lower? Those are not signs of weakness. Those are signs of absorption. Big money doesn't chase price higher. They build positions when no one is watching, when sentiment is neutral to negative, and when retail confidence is low. That's when risk is lowest for them. That's when patience pays. And here's the part most people miss. The move toward $100 silver doesn't start at $80 or $90. It starts in moments like this, when price feels disappointing and unexciting. Explosive moves are built on long periods of frustration. That's how markets transfer wealth. Now, I'm not saying silver goes straight up tomorrow. That's not how engineered markets work. What I am saying is that this window right here is critical. February into March is when positioning happens. It's when narratives are reset. And it's when decisions made quietly end up looking brilliant in hindsight. This is also why emotional discipline matters more now than at any other point in the cycle. The goal of this fake crash is not to bankrupt you. It's to wear you down, to make you doubt your thesis, to make you question your patience. Because if you give up here, you don't get to participate later. If this perspective is already shifting how you see the current move, drop a quick comment saying still watching. It helps engagement, and I read far more comments than you might think. And if you know someone who's confused or nervous about silver right now, share this video with them. Sometimes all it takes is a different lens to stop someone from making a decision they'll regret. In the next part, we're going to break down exactly how smart money accumulates during moments like this, what signals matter and which ones are pure noise, and why the coming weeks could quietly lock in positioning that fuels the next major leg higher. Most people won't see it happening, but you will. One of the biggest mistakes people make during moments like this is assuming that accumulation looks obvious. They imagine large green candles, headlines screaming institutional buying, and analysts suddenly turning bullish. That almost never happens. Real accumulation is quiet. It's subtle. It hides behind boredom. And it often happens while price is moving sideways or slightly down, exactly like what we're seeing in silver right now. Smart money doesn't need excitement. They need time. Time to build positions without moving the market against themselves. If they tried to buy aggressively, price would spike and expose their intentions. So instead, they let price drift. They let negative sentiment do the heavy lifting. They let retail sellers provide liquidity. This is why engineered moves feel slow and frustrating. That frustration is the mechanism. Another important thing to understand is that price alone doesn't tell the full story. You have to watch how price reacts to pressure. Every market is constantly being tested. Bad news, rate expectations, dollar strength, equity volatility. In a weak market, those pressures cause breakdowns. In a strong market, they get absorbed. Silver, despite all the noise, keeps absorbing. Notice how each dip fails to accelerate. Notice how support levels, even when briefly broken, don't lead to cascading sell-offs. That's not coincidence. That's controlled damage. Someone is willing to take the other side of fear, but they're doing it without urgency. That tells you everything you need to know about confidence. This is also where timing becomes critical. February into March isn't just another couple of months on the calendar. It's when positioning shifts ahead of larger macro moves. It's when contracts reset. It's when portfolios quietly rebalance. And it's when narratives get rewritten before the public notices. Think about how narratives work. First, silver is ignored. Then it rallies and gets attention. Then it pulls back and gets labeled dead money. That label is powerful. It discourages participation. It keeps money on the sidelines. And it allows accumulation to continue under the radar. Only after positioning is complete does the narrative flip again. And when it flips fast. Suddenly, the same price levels that felt heavy become launchpads. Resistance turns into support. Headlines change tone. Analysts revise targets upward. And retail re-enters, but at much higher prices. That's the cycle. It's uncomfortable by design. There is also something else happening beneath the surface that most people don't connect to silver right away. Liquidity is tightening, not in a dramatic overnight way, but gradually, quietly. And when liquidity tightens, volatility doesn't disappear. It gets delayed, it gets compressed, and then it releases. Silver is especially sensitive to this because it has a relatively small market compared to global capital flows. It doesn't take much new demand to move it dramatically. But before that demand shows up, price is often pushed lower to discourage early positioning. That's exactly what a shakeout is meant to do. A real crash creates forced selling. A fake crash creates voluntary selling. That distinction matters. In a forced sell-off, people have no choice. In a voluntary one, people talk themselves into exiting. They rationalize it. They convince themselves they'll buy back later. and most never do. This is why experienced market participants don't obsess over short-term price fluctuations. They focus on structure. Is the long-term structure broken, or is it intact but under pressure? In silver's case, the structure is intact. The range is frustrating, but it's not destructive. And frustration is not bearish, it's preparatory. You also have to consider positioning psychology. When everyone is positioned the same way, markets reverse. When everyone expects upside, downside pressure appears. When everyone expects collapse, upside surprises happen. Right now, sentiment has cooled dramatically, even though the long-term case hasn't changed. That divergence is where opportunity lives. And let's be clear about one thing. Moves toward $100 silver don't happen in a straight line, and they don't happen with comfort. They happen after people are shaken out, after conviction is tested, and after patience is rewarded. The foundation for that move is not built during hype phases. It's built during moments like this. This is also where personal strategy matters. Smart money isn't emotional about price. They're methodical. They know what they're accumulating and why. They don't panic on red days, and they don't chase green ones. They let time work in their favor. That's the advantage of understanding the game instead of reacting to it. If you're still here watching this, it means you're already ahead of most viewers who click away the moment things get uncomfortable. That alone changes your outcome. And if this breakdown is helping you stay grounded while the noise ramps up, hit the like button if you haven't already. It helps this message reach people who are being pushed out by fear instead of facts. Now, as we move closer to the end of this window, the pressure will likely increase. That's how these setups work. Doubt intensifies before clarity arrives. The market doesn't reward comfort. It rewards preparation. And right now, preparation means understanding that this move is not about today's price, but about tomorrow's positioning. In the final part, we're going to connect all of this together. We'll talk about what changes when the accumulation phase ends, how the narrative shifts almost overnight, and why the move toward triple-digit silver will catch most people completely off guard, even though the signs are already here. This is where patience turns into payoff. At some point, and it usually happens when the fewest people expect it, the accumulation phase ends. There's no announcement, no warning bell, just a subtle shift in behavior. Dips stop going as deep. Recoveries happen faster. What used to feel heavy suddenly feels light. That's how you know control is changing hands. This is where most people get confused, because by the time price starts moving with confidence again, the best positioning has already been done. The groundwork is invisible. All the frustration, all the boredom, all the doubt, that was the setup. The release is the reward. When that shift happens, narratives change almost overnight. The same commentators who were calling silver a failed trade suddenly start talking about supply constraints, industrial demand, and monetary hedges. Targets that once sounded unrealistic begin to feel conservative. And the people who exited during the shakeout realize they were being invited back in at much higher prices. That's how engineered markets work. They don't steal from you directly. They invite you to make the wrong decision at the wrong time. This is why the move toward $100 silver won't feel obvious until it is already well underway. By the time it feels safe, by the time it feels confirmed, the easy part of the move will be gone. And that's not pessimism, that's historical pattern. Silver doesn't need a perfect macro environment to move higher. It needs imbalance. It needs positioning pressure. It needs demand to meet limited supply. And those ingredients don't announce themselves loudly. They build quietly, while attention is elsewhere. Think about how fast sentiment can flip. All it takes is one catalyst, one shift in expectations, one realization that price has been suppressed longer than it should have been. When that happens, silver doesn't climb slowly. It reprices. And repricing is violent. That's why shakeouts are so important to the process. They reduce resistance. They thin out participation. They leave fewer sellers when demand finally steps in. Every person who exits now is one less obstacle later. This is also where discipline separates outcomes. Not everyone needs to agree with this view. Markets don't require consensus to move. In fact, consensus usually delays real moves. What matters is understanding the structure and respecting the process. Right now, the process is testing patience. It's asking one question over and over again. Do you trust your understanding, or do you react to discomfort? Most people answer that question emotionally. A few answer it strategically. And that's why channels like the silent ledger exist. Not to predict exact days or prices, but to help you see what's happening beneath the surface when the surface looks deceptive. Because the most important moves don't start with excitement. They start with confusion. If silver was truly broken, you wouldn't need this much effort to push it lower. It would fall on its own. The fact that it hasn't tells you something important. The pressure is artificial, the timing is intentional, and the objective is psychological. As this window closes, pay attention not to headlines, but to behavior. Watch how price reacts to fear. Watch how quickly dips recover. Watch how sentiment stays negative even as structure remains intact. Those are the signals that matter. When the move finally begins, it won't ask for permission. It won't wait for consensus. It will simply go. And the same people who are hesitant now will rush in later, asking how they missed it. The answer will be simple. They mistook a setup for a failure. If you've stayed with me until this point, you already understand more than most participants ever will. And that understanding is your edge. Markets reward those who can stay calm while others get shaken out. Before you go, I want to hear from you. Do you think this move in silver is a real breakdown or an engineered shakeout? Drop your thoughts in the comments. I read them, and the discussion helps everyone see different perspectives. If this video helped clarify what's really happening, share it with someone who's on the fence right now. Sometimes the right information at the right moment changes everything. And make sure you're subscribed, because when this narrative flips, you'll want to be ahead of it, not reacting to it. Stay patient. Stay aware. And remember, the biggest moves always begin when silence is loudest.